Conversation forward with Upasana Chachra, Chief India Economist with Morgan Stanley. Upasana, good morning. Thank you for joining us. What should we expect to hear on India's GDP later in the evening?
Hi. So our number is also similar to the consensus estimates. We do expect GDP growth to be sub 5 at about 4.6% for the December quarter. But I think I'll point out that we should view this number in context of the high base, and also the sequentially the activity indicators and the GDP numbers are going to now normalize. So I don't think we should view this number as indicative of any major slowdown or moderation in the growth trend, but in context of normalization in the activity trends post, the pent up that we saw in calendar 21, and therefore the base was therefore stronger, especially if you look at sequential activity numbers in that quarter.
Apart from the headline number, what about the fine print? In terms of the sectoral composition, the category composition, where do you expect a surprise?
So versus say the September quarter, we expect agriculture growth to be relatively steady and probably in similar terms in on a YOY basis. On the services side as well, we've seen from high frequency data that services indicators remain pretty okay in the December quarter. If you look at PMI services, air travel, hotel occupancy, other indicators which go in the financing, like the real credit growth, deposit growth numbers. So I think services will hold up. There could be some pockets where sequentially indicators have slowed. But overall services should hold up. On the manufacturing or the overall industry segment wise, I think manufacturing will probably continue to see some drag, again basis the high frequency like the IIP numbers that we got in the December quarter. Um, and also the impact of the global slowdown and still elevated commodity prices, which have impacted profitability trends. But within the industrial segment, I think construction will be a bright spot basis the trend that we've seen in cement and steel consumption that we're seeing on the basis of the high frequency trend. So I think manufacturing will probably be a little bit downbeat, but probably but less of a drag versus September quarter, as we are seeing that corporate profitability trends, while declined by less in the December quarter versus what we saw in September. So I think there'll be a little moderation in the numbers on both services and manufacturing, but manufacturing may be a bit more of a drag on the overall trend.
Upasana, also I wanted to understand and get your sense in on what is it that you're seeing about the rural end of the economy, because that all and every indicator seems to be hinting towards in a suppressed state right now. Do you see any green shoots emerging, and do you think rural demand is going to come back anytime soon?
So, the rural demand or activity indicators that we track on a high frequency basis, yes, remain a little lackluster. But having said that, I think the worst is probably behind us. We track rural activity on a consolidated basis, all the high frequency data points like two-wheelers, tractor sales, fertilizers, agri credit, etc. that we get. And what our indicator is showing is that it's sort of steady. So the worst is definitely behind us. And I think if we look at some of the leading indicators like winter crop sowing trend, the some of the improvement that we are seeing in incoming January data from say two-wheeler sales, and also I think the overall normalization in the labor market, by which I mean that the informal or the unorganized sector, which was impacted more severely by the pandemic-led disruptions, has now gone back to their usual forms of livelihood. That's evident if we look at the work demanded under NREGA, which is going down on a YOY basis. And I think that that normalization in the livelihoods or the labor market will have an impact on rural demand. There would be some lag, and therefore we have not really seen that in the numbers as yet. But I do think that we will see that in the numbers in the next few months, and we will see better rural demand indicators in the next probably 3 to 6 months than what we've seen in the past. So we are optimistic or constructive on the rural demand, and we do think that the worst is behind us on that front.
Hi, there's also concerns regarding the private capex cycle not exactly picking up. What exactly do you believe are still some of the stumbling blocks there, and when do you think we could see a meaningful recovery?
So on the private capex side, I think all the ingredients are in place for the capex cycle to kick in, be it in terms of what the government has done in terms of reforms or improvement in demand. So if you look at all narrative and commentary around growth trends, we are seeing that domestic demand is holding up. Domestic demand indicators are picking up pace. That's getting reflected in capacity utilization rates as well. And the balance sheet positions for both the corporates and the financial sector are the best in the last decade. So I think all the ingredients are in place. It's all about that now culminating, and we're seeing that in real numbers. I think on that front as well, if we look at some of the high frequency data points like new capex investments or announcements through the CMI database, that is showing a pickup. We are seeing that private projects under implementation or private sector new investments are now picking up pace, and I think we will continue to see that gain traction in fiscal 24, because as I mentioned, all the ingredients are in place, and the government is also pushing for capital expenditure on the infrastructure side, which I think will again help to crowd in private investment. So I think fiscal 24 is when we'll see probably a more meaningful traction to the private capex cycle.
Upasana, great to have you on the show. Thanks as always for joining in with that view on where the economy is headed and more importantly, what the GDP print today is going to entail.